Well, good morning, everybody. We're going to go ahead and get started. If everyone can grab a seat. We do have a terrific crowd here today, so I really want to thank everybody for joining us. My name is Mark Benzequin. I am with the Options Industry Council. I'm part of the Investor Services team at the OIC. And just want to explain a little bit about what's going on today. It's a three-part session that we have designed for option beginners to intermediate investors. We're going to start out with core concepts. We're going to start out with what options are, why we trade them, how we use them. The second session, my partner Kevin Davitt from the CBOE. The CBOE is going to be talking about some of the different ways to build an options trade. And then the third session, we're going to co-present, and we're going to look at some of the more popular option strategies out there. Again, my name is Mark Benzequin. I've been in the business for a little bit over 20 years now. Most of my time was spent on the trading floor at the CBOE. I was one of those ridiculous people that you see on TV waving their hands and screaming and shouting. And I did that for about 20 years, which is why my hair looks the way that it does now, unfortunately. When I got out of the business, one of the things that I was looking to do, or I should say when I got off of the trading floor, one of the things I was looking to do was possibly get into education. And I was talking to Nick and Diane earlier, and teachers. And so we were kind of, talking about teaching and education. And I told them that one of the things that I love about OIC and my position here at OIC now is that I get to interact with investors. I get to talk personally with them, get in their face, talk to them on the phone, talk to them via email, and really try to explain to them what options trading is all about. We'll get into OIC a little bit, touch base on what we're here for. But like I said, I just wanted to introduce myself a little bit and get to know everybody. Again, thank you so much for joining us. It's you're taking a big part out of your day to be here today, so I really appreciate that. And these option concepts that we're going to be talking about, these are complex issues, right? These are complex concepts. It's not always easy for everybody to understand. And if you're a beginner investor, we don't expect you to leave here today and begin trading iron condors or butterflies, right? What we hope is that when you leave here today, you walk away with one or two, core concepts, some ideas, maybe a better idea of what options are and how to use them, maybe a better idea of how to incorporate them into your trading and your investing portfolio, and also a better idea of who OIC is, the Options Industry Council. We are a tool and a resource for you to use, and we certainly want you to do that. So let's go ahead and get started here. Every time that you attend an options presentation, you're going to see a standard disclaimer like this. And basically what it's telling us is that options are not suitable for everybody. In order to trade options, your account needs to be approved by your broker. Part of that approval process is that you acknowledge the receipt and the understanding of a document that is called the Characteristics and Risks of Standardized Options. It's called the Options Disclosure Document is what we call it for short. Characteristics and Risks of Standardized Options. It's kind of a mouthful, right? So we call it the ODD. You can get a copy at your broker. You can get a copy here from the Options Industry Council. We'd be happy to send you one. But basically when you open that account, you need to acknowledge that you understand that document. Also, the disclaimer tells us that for our purposes today, we're going to try to keep things simple. We're not going to be talking about commissions. We're not going to be talking about taxes and other fees that may impact your trading account. So all the examples that we're going to be looking at, we're simply going to be looking at from a cash standpoint. We're not going to be looking at these other fees that would impact your account. So definitely take that into consideration. And then lastly, these situations and these scenarios and examples that we're going to be talking about are simply going to be from an educational standpoint. We're not trying to make recommendations. We are not trying to entice people to trade options. We simply want you to understand what they are. Now, the OIC, as I explained, it's the Options Industry Council. We are a not-for-profit resource. We are funded wholly by the OCC, the Options Clearing Corporation. Our mandate, as I was explaining to some people earlier, our mandate, the only product that we have to sell is options education. We are completely unbiased. We're not trying to push an agenda. We're not trying to sell you on anything, okay? There's no cost for any of our resources, whether it's our online resources, where we have videos and podcasts at our website, optionseducation.org. We also have monthly options webinars that we offer twice a month. We also have our investor services team, of which I am a part. You can give us a call, you can shoot us an email, go on the website, and you can even online chat with us. All of our resources completely free of charge. Now, here's a slide that our director, Joe Burgoyne, this is probably his favorite thing. He can talk about this all day long. The options industry the options industry by itself, you can see the volume as it spiked over the last several years. So the markets were created back in the early 70s. 1973, the CBOE was the first exchange to come online. And for a number of years, as you can see, even a number of decades, trading was relatively flat. The very first day of trading, I believe there were 16 companies that traded options, a few hundred options contracts, traded hands. Now we're averaging about 16 million contracts a day. This year, we're actually averaging more, probably about 20 million contracts a day. Some of that is the extent or the invention of online trading, electronic trading, okay? Some of it is due to new products that they have. ETFs, for example, really came online in the early part of the 2000s, and volume really exploded because of that. We also like to think that some of that is because of education. When people know more about something, they're going to be less afraid of it. They're going to be more willing to use it. So we like to think that the OIC played a small role in that. So let's go ahead and get started with what we're going to talk about today. Here's our outline. First, we're going to look at what options are and why we use them, different types of options. We're going to look at specific contract terms and some of the different processes that are involved in options trading, such as exercise and assignment. Then we're going to get into pricing, what we call in the money, out of the money, at the money, so some of the different option pricing concepts, as well as talking about premium, the amount that we're buying and selling. And then, as I had mentioned, we're going to have a Q&A session at the end where we'll certainly be happy to take your questions, both from our live audience and our online community, and then we're going to go ahead and wrap things up. So, defining options, what are they? When we learn about something, the easiest way to start is at the very beginning, obviously. Options are contracts, okay? Simply put, it's a contract between a buyer and a seller. And with any type of contract, there is rights and obligations that are conferred upon each person. The buyer of an option has the right to buy or sell stock or shares of an ETF, or it could be cash, depending on the product that we're talking about. The buyers have rights, and the sellers have options. The sellers have obligations. Now, the stock that we're going to be buying, the shares that we're going to be buying, there's a specific price. We know that we can buy these shares at a specific price within a specific period of time. And these are all terms that are going to be defined within that option contract. But the key concept that I want you to take away from this particular slide, this very first slide, is that buyers have rights and sellers have obligations. One of the things about learning about options is going to be repetition. All right, so some of the slides that you're going to see, some of the terms and things that we're going to be talking about, we're going to be talking about them over and over and over again. We want it to sink in. First and foremost, buyers have rights, sellers have obligations. Now, why would we use options? All right, when it comes to investing, for example, if we're looking at bonds, if we're looking at stock, something like that, we've got limited choices. We can buy them, we can sell them. With options, it gives us more ways to implement our market research. We think the stock's going to go up. Well, rather than just buying those shares, there's different ways that we could take advantage of that stock going up, assuming that we're correct. We can also reduce our risk. We can also generate income. We can also buy shares. So options can help us do all of these things. Options can also help us leverage our money. Rather than buying shares of stock and committing a large amount of capital to it, we can commit a much smaller amount of capital to options and leverage our money, and we'll get into that a little bit as well. But really, this is what it's all about. You know, the word option means choice, right? And that's exactly what stock options, or the financial options that we're talking about here, that's really what it does. It gives us choice, it gives us flexibility. So if we were to just invest without options, if we were to just buy stock, for example, if the stock goes up, we make money. Stock goes down, we lose money. Stock doesn't move, right? Stays the same, maybe stays within a trading range. We don't, you know, nothing happens. We don't make any money. If we sell stock short, right, the exact opposite. Stock goes up, we lose money. Stock goes down, we make money. Stock doesn't move, nothing happens. So without options, our choices are limited. Our options are limited. With options that we're talking about today, look at this. Dozens and dozens of ways that we can take advantage of our market outlook. Dozens and dozens of ways that we could take advantage of what the market is doing. If the market goes up, we can take advantage of it. If the market goes down, we could take advantage of it. If the market doesn't move anywhere, we could take advantage of that. So that's something that we don't have with just stock, if we just invest in stock. So it's definitely one of the reasons that options were created, to give us more ways to take advantage of our investing. So options are actually, even though they're a complex concept, they're fairly simple in terms of the mechanics. There's only two types of options. There's calls and puts. Right? That's it. So with the call, okay, first let's talk about this. As I mentioned, that when we invest in options, it gives us the advantage, or the option to buy or sell stock. Today we're going to be talking about equity options and ETF options. And what that's going to represent is 100 shares of stock of a company or 100 shares of the ETF. There's also index options. You may have heard of the SPX, for example, the NASDAQ index, the VIX. Right, so those are going to be different. That's not going to be shares of those indices. That's going to be cash-based, and we'll get into that in a little bit. But with equity call options, when we buy that call, it gives us the right to buy shares. So calls are really the easiest to understand. When you buy a call, you have the right to buy shares at a specific strike price within a specific period of time. When you sell that call, you have the obligation to sell shares of stock at that specific strike price within a specific period of time. Puts are going to be the opposite. When you buy a put, you have the right to sell shares. When you sell a put, you have the obligation to buy shares. And for those of you that have downloaded this presentation ahead of time, this is a slide that you're going to want to print out. A long call buyer, right? When we talk about being long the option, we mean that you're buying the asset, you're buying that option. You're also known as the holder. So a long call buyer has the right to buy 100 shares of stock at a specific price within a specific period of time. The put buyer has the right to sell the stock at a specific price at a specific period of time. And again, we're going over this, we're repeating this from the previous slides. Again, it's the repetition. But what I like about this slide is it breaks it all down into one neat graph, one neat table for us. So the short call seller, right, or the writer of the option, when you sell something, you have the obligation. So now we're selling calls, we have the obligation to sell stock at a specific price within a specific period of time. If you are selling the put, you have the obligation to buy shares at a specific price within a specific period of time. Go ahead, sir. No, wherever you think that there might be room. Now, when it comes to option contracts, because it's a contract, they have defined terms, right? If you've engaged in a contract before, If you've engaged in a contract before, you know ahead of time what you're getting into. And options are very, very similar. So all options have an expiration date. Just like every contract, right? They don't last forever. They have a specific period of time that they are good for. Some of the standardized terms that they have is how many shares of stock the contract represents, the underlying, so we know the company that we have the right to buy or sell those shares upon. We also have the strike or the exercise price. And these are all terms that we're going to go ahead and break down in just a moment. So let's look at a sample trade. XYZ, Jan 17, 2020, 45 call at 250. All right, it's a lot of words. It's a lot of numbers. It's a lot of, foreign, what does that mean, right? Right, exactly. Yes, Nick. So what does this mean? Well, let's break this down. XYZ is going to be our underlying. That's the company with which we have the right to buy or sell shares. All right, XYZ, that's the underlying. That's the company that this option is going to represent. Now, the expiration date, January 17, 2020, from the time the option contract is executed until Jan 17 of 2020, that option is in effect. That contract is good. That contract is live. Now, what happens during that time is, the buyer has the right to buy or sell shares within that certain period, depending on the option contract. 45 call. All right, 45 is the strike price. That is the price at which we are either agreeing to buy shares or committing ourselves to sell shares. That's that strike price or that exercise price. When we execute that option contract, when we basically call that option contract due, that's the price at which we're buying or selling shares. And then the last item there, the $2.50, that's going to be our option premium. For the right to buy those shares at $45, we're going to be paying $2.50. Now, when it comes to the world of options, typically these dollar amounts are multiplied by 100 because the option contract represents 100 shares of stock. So that $2.50, the $2.50, is actually $250. So for me, in this particular example here, for me to buy those shares, if I bought this option contract, if I bought this call, I now have the right to buy 100 shares of stock, of XYZ stock. I have the right to buy 100 shares of XYZ at $45 a share. That right is going to cost me $250. As the seller, I am accepting the obligation to sell 100 shares of XYZ at $45. For that obligation, I am collecting $250. And we'll get into, actually Kevin will get into a little bit later about buying and selling calls and how exactly that mechanism is going to work. Exercise and assignment. Now, when we enter into an option contract, it's just that. It's just a contract. It doesn't actually do anything until we decide, or until the choice is made for us, depending on which side of the trade we're on, until we decide that we want to make the terms of that contract good. The way that we do that is called exercise. So let's say I buy an option contract from Nick here, and I want to make the terms, I want to go ahead and buy those shares for $45 like we had on that last slide. I'm going to go ahead and exercise my right to buy those shares. And the process is called exercise. So again, to repeat from earlier, buyers have the right to purchase stock at the strike price within a certain period of time if I exercise that contract. Now, only buyers can exercise. Sellers get assigned. Sellers have the obligation to sell those shares, assuming we're talking calls. Sellers have the obligation to sell those shares of stock, again, at the strike price within a specific period of time if they get assigned. And only sellers can get assigned. The way the process works is it's actually fairly interesting, and it's one of the questions that we get asked often at the OIC. how does not necessarily the exercise process, but really how does the assignment process work? So the way that the whole process goes is, again, I buy an option contract, sir, I buy an option contract from you. I decide the market is favorable. I decide I want to go ahead and make the terms of that contract good. I want you to commit to selling me those shares that we had talked about. So I'm going to go ahead, as the buyer, I'm going to go ahead and notify my broker or my trading firm of my intent to exercise that contract. Now, the OCC, the Options Clearing Corporation that we spoke of a little bit ago, our parent company, they facilitate the exercise and assignment process on behalf of clearing firms and trading firms around the world and investors around the world. So the OCC has a process that we call X by X, exercise by exception, or auto exercise. If your option is in the money by a penny or more, and we'll get into what in the money means in just a second, but if your option is in the money by a penny or more, that contract will automatically get exercised. You don't need to do anything. All right, so I have an option contract with you. It's in the money. I don't need to do anything. My broker is automatically going to exercise that contract, and my broker will then send those instructions to their clearing firm, to my broker's broker, basically. My broker's broker will then send that information to the OCC that they have a company, they have a trading firm who has an investor with a long option position, and they wish to exercise that contract. Now, the way the assignment process works, this is where things get a little interesting. The SEC has a random approval process that the OCC uses in order to assign the contract. So I bought my contract from you, let's say, and I decide to exercise. Doesn't necessarily mean that you are going to have to sell those shares. The reason being is, what if this gentleman, the minute after I traded my contract with him, he decided to go ahead and trade out of that contract. I bought options from him, so he sold them to me. 10 minutes later, turns out it's profitable for him, and he goes ahead and closes out that contract. Well, if he doesn't have that position anymore, then he will not be subject to assignment. I will have to find somebody else to buy those shares for, or from, I should say. But it's not really my responsibility to find somebody. It's going to be my broker and their clearing firm, and subsequently the OCC. So what the OCC is going to do is they will randomly assign a clearing member firm, who will then randomly assign a trading firm, who will then randomly assign an investor that has a short option position. You know, one of the things that people generally don't understand about options trading, or how the market works, is just because you bought an option from somebody. You know, again, I bought an option contract from you. Once, at the end of the day, after that option contract clears, the relationship between me and this gentleman is gone. We no longer have a buyer-seller relationship. The OCC acts as the counterparty for every option contract that trades. And if I bought an option from him and he turned around and closed it out in the market, then that means that he bought that contract back and somebody else sold it to him. So now maybe my relationship is with this gentleman because they did a trade. Okay? And then now maybe this gentleman closed it out, and you know, maybe this lady, maybe you were the one that sold it to him. So the point being is that option contracts trade all day long. People trade in and out of option contracts all day long. You don't have to buy an option and hold it until it expires. You can absolutely trade out of it the minute after you execute. Okay? So that's where the OCC comes in on the assignment process, is because the initial relationship that you have with the trader, when you first execute that contract, that relationship gets severed and no longer exists after that point. Now, exercise style, we talked about shares of stock. Okay, there's a couple different exercise styles, one of which is called the American style of exercise. What the American style tells us is that if I buy an option contract as the buyer, I have the right to exercise that option at any time for any reason. At any time for any reason. Now, what that also means is that if you sell that option contract, you can be assigned at any time for any reason. If any of you are familiar with options trading and are familiar with maybe the concept of in the money, again, which we'll get in just a moment, a lot of people may have the idea that you can only exercise a contract if it's in the money, or you can only be assigned on your contract if it is in the money. That absolutely is not true. You can be assigned, assuming an American-style exercise, you can be assigned at any time. Now, the American-style exercise, that's the bulk of investing. Those are your equities, okay? Your stocks that you buy and sell options on. The ETFs upon which you buy or sell options. That is what we call American-style expiry. The other is European. European can only be exercised on expiration day. That's going to be typically our indexes, the SPX, the NASDAQ, the Russell, the VIX, the Dow Jones, okay? Those are the European exercise. You can only exercise at expiration. Now, if you have a weekly contract, typically when I got into the business, there was only monthly option contracts. So in the monthly option contract, your contract would expire the third Friday of the month. And expiration was actually such a big deal that you had to plan your vacations, your days off, you had to plan it around expiration week. I had to plan my wedding around expiration week. You could not take time off work during expiration week. It was the busiest week of your month. And like I said, I was a broker for about 20 years. I probably did about 70% of my business during expiration week. If you had a bad expiration week, you're going to have a bad month. If you had a good expiration week, you can take the rest of the month off. So that was nice. But now we've got weekly contracts. And now not only do we have weekly contracts, but we have weekly contracts that expire on Mondays and Wednesdays and Fridays. So you basically now have expiration pretty much, almost every day of the week. Pretty soon I'm expecting they're going to have Tuesday expirations, Thursday expirations, and now every day is going to be an expiration. So it kind of takes some of the importance out of expiration week in terms of, being an investor. But European contracts, you can only exercise on expiration day. And one of the attractive things about that, certainly for institutional investors, is they don't have to worry about early exercise. All right, if you sell an option contract, typically your reason for selling is income. All right, and again, Kevin's going to get into that in a little bit later, but you're looking to generate income from selling that option contract. The last thing that you want, well, let me back up for a second. You're looking for income, and the way that you make that income, you collect that premium, and that option expires worthless. That premium is now yours to keep. That's your profit. The last thing that you want is to be thinking that I'm going to collect this premium, and now you get assigned. And now you've got to go ahead and sell those shares that you didn't expect to. All right, so with European exercise, you don't have that surprise of early exercise. And for that reason, that's one of the reasons that the SPX, how many of you have heard of the S&P 500? I'm assuming the majority, so perfect. So the S&P 500, the SPX option, it's one of the more popular option contracts out there. It is the benchmark of investing for institutional investors, banks, things like that, simply because there's not the automatic exercise, number one. Number two, it's also because it's cash settled. Now, the settlement style, we've got physical delivery and cash delivery. Physical delivery is where you actually take delivery of shares of stock. I exercise my contract, I buy that XYZ call, I exercise the contract, now I have shares of that stock, or I have shares of that ETF. with cash delivery, there is no ETF, there is no shares of stock, it's simply cash. So your option contract is going to be settled for the difference between your strike price and that settlement price. So that's another reason why those indices, those indexes are so popular. European exercise style and cash settled. There are, physically settled commodities, for example. Oil, right? I think an oil contract, the standard contract, here we're talking about 100 shares of stock. With oil, I believe it's 25,000 barrels of oil. How many people do you think actually take delivery of 25,000 barrels of oil? Right? You have very few. And that's not to say that there haven't been exceptions. There's a story that my partner tells that he knew of somebody who went on vacation, who had a position in oil, and went on vacation and forgot that it expired, did not trade out of the contract, and when he got back from vacation, called his broker and said, "My gosh, I forgot that this expired. It was exercised. What do I do?" And the broker said, "You need to find a big pool because you've got 25,000 barrels on the way, and you need a place to store them." So physical delivery, you actually take delivery of the underlying, whether it's shares of stock, shares of the ETF, head of cattle. Right? What if you get 25,000 cows coming in your driveway? That's going to be tricky to explain to your spouse. So that's that's the reason that option contracts are traded in and out of every day. You don't have to let them expire. You can trade out of it. And as a matter of fact, a little over 70% of option contracts never live to see expiration. They get traded out of on a daily basis. I buy the contract, 10 minutes later, the stock goes the way I thought it was going to. I sell out of that contract, I take my profit, and I move on. Or the other way, I buy my contract, things are going south on me. I've got when you get into a contract, you should always know, well, let me back up for a second. When you trade, and this is something that I think Kevin's going to get into a little bit, when you trade, you should always have a plan, not only when to get into the stock or when to get into the option, but when to get out. The old Kenny Rogers saying, right? You got to know when to, know when to hold them, know when to fold them, right? Does anyone know the words to that? Want to sing it for me? Sir, I think you do. So you need, it's just as important to know when to get out as it is when to get in. So just because you're in a contract, if it's going your way, fantastic. Get out of it, if that's your choice. My partner on the investor services desk, one of his favorite sayings is, "You'll never go broke taking a profit." And he's absolutely right. You're making some money, get out of it, and take that money and live to play another day. Use that money to invest in something else. Conversely, sometimes the hardest trade to make is the one that's going to cost you money. Right? In my, all my time on the trading floor, boy, there were so many times when I was chasing a trade and I was losing on it. And I didn't want, if I got out of it now, I'm going to lose $5,000. 5 minutes later, now I'm down $10,000. And I'm down $25,000. Serious money. Sometimes the longer you wait, the more it's going to cost. If I had just bit the bullet and folded them when I should have, I could have seriously, reduced my losses. Instead, sometimes I rode those losses until I had no choice to get out of them. And believe me, my boss was not very happy with me. It made for a very long train ride home. So that's just a little bit about different ways to go on that. Now we kept talking about in the money, at the money, out of the money, and if you're unclear, if you don't know ahead of time what that is, it sounds like we're talking Greek, right? In the money, at the money, out of the money. For those of you that are my age or older, you may remember the song "We're in the Money." I think that was like from a musical, 42nd Street or something like that. What in the money means to me, the way I explain it, is, I try to look at everything from the point of view of calls. To me, calls are the easiest thing to understand. You buy a call, you have the right to buy stock. You sell a call, you have the obligation to sell stock. Easy. Buy call, buy stock, sell call, sell stock. It's easy to remember. In the money, the way that I look at it is, where do I want to buy that stock? If stock is trading $50, do I want to buy that stock for more than $50 or less than $50? Yeah, I want to buy it for less. So to me, if the strike price, and remember from earlier, the strike price is the price at which we have the right to purchase those shares. If the strike price is less than the stock price, well, that's what I want to do. If stock's trading $50, I'd love to buy it for $45. Okay, so to me, that's in the money. That's the way I explain to people the concept of in the money. At the money is the easiest of all. It's when the stock price and your strike price are the exact same. I have the right to buy shares for $50. Shares are $50 in the open market. That's at the money. Out of the money is where the stock price, or I should say the strike price, is above the stock price when it comes to calls. Do I want to buy shares of stock for $55 when they're trading $50 in the market? Nick? No, of course not, right? You do that trade, you're not a very successful trader and you don't last very long. And again, we do talk to people that, ask us, look, I want to buy this stock. I like this stock. I've got a $55 call. Stock's trading $53 right now. Should I exercise my call? First and foremost, we tell them, sir or ma'am, the one thing we cannot do is provide advice. We cannot make recommendations. But let me ask you this. Do you want to buy shares for $55 when they're trading $53 in the market? And then invariably we get a, well, no. If I can get them cheaper in the market, why wouldn't I do that? Exactly. So that's the out of the money contract, okay? Puts are going to be the exact opposite. Puts is, where do you want to sell shares? Stock's trading 50. Do you want to sell that stock above where it's trading in the market or below where it's trading in the market? Obviously, we want to trade it above, okay? This isn't, when it comes in, at, and out of the money, it's certainly not rocket science. It's not one of the more complex concepts of options trading. So with puts, if the strike price is above the stock price, that's in the money. At the money and out of the money work the same thing. At the money is where the shares and the strike price are the same. Out of the money is where the strike price is below the stock price. Do I want to sell shares at 45 when it's trading 50? Certainly not. So that is in, at, and out of the money. And the reason that we look at that, well, going back to that concept of exercise, right? Your option is automatically going to be exercised if it is considered in the money. So if your option contract is at least 1 penny in the money or more, bless you, sir. I'm sorry, I lost my train of thought there. Your fault. If your contract is in the money by at least a penny, your broker likely is going to exercise that contract. Now, one thing that you're going to want to do, we talked in the very, very beginning about getting approved to trade options and getting a copy of the ODD and et cetera, et cetera. One of the things that you want to do before you get approved for that options account is you want to talk to your broker. What are their policies regarding exercise? You want to know what are their processes for assignment. You want to be as familiar with that broker as they want to be familiar with you. Okay? You're interviewing them just as much as they're interviewing you. So definitely something to be familiar with. Now let's take a little quiz. This will be fun. Let's look at in, at, and out of the money. We've got a stock price of $55, and our strike is $65. $65 call. Is that $65 call in, at, or out of the money? Out. Everyone think out. Does anyone think in or at? Good. Either you're very, very smart or I'm doing an excellent job. My guess it's the former. Well, thank you. I appreciate that. So yes, that is out of the money. $77 stock and a $70 call. In, at, or out of the money? In the money. Very good. Puts. Puts, I think puts are a little bit more complex than calls. Again, calls make sense. Buy a call, you buy stock. Sell a call, you sell stock. Puts are going to be the opposite. So this might be a little tricky. $70 put, $63 stock. In, at, or out? In the money. Excellent. 45 put, 51 stock. In, at, or out? Wow, you guys are good. Here's tricky. All right, this one's going to be really close. 22.55, 22 double stock. In the money. All right? So we've got a 22 half call. I have the right to buy shares for 22 and a half. Shares are currently trading 22.55. That is in the money. And again, the reason being is I can buy shares for $22.50. Theoretically, I can turn them around right away and sell them to the market at $22.55. I make a whopping 5-cent profit per share. All right? You can go on vacation with that. Premium. This is where sometimes things might get a little tricky. When we trade an option, obviously, if I'm going to have the right to buy stock, possibly below where it's trading, well, I've got to pay something for it, right? If I'm a seller and somebody comes to me and says, look, you've got an asset worth $100. I want to buy it for 90. Well, no, I'm not going to do that. But if they said, how about I buy the right to buy that asset for 90? And in order for me to have that right, I'll give you, a little something extra. Well, that something extra is going to be premium. So a buyer pays the premium, the seller receives it. As the buyer, once you pay that premium, it's gone. It comes out of your account and it goes to the seller. As the seller, once you collect that premium, that is yours to keep, regardless of what happens with the option. Okay? Now, a couple things. Once you collect that premium, that doesn't mean that you can turn around and do what you want with it, because that premium represents an obligation that you just enacted into. So your broker is going to hold on to that money until that obligation is filled. Number one. Number two, that's not to say, whether you're the buyer or the seller, that's not to say that that money is gone forever. If you're the buyer, that doesn't mean that I paid $100 and then $100 is gone. If the market goes the way that I want, I could always turn around and sell that call back to the market for $120. Right? That $100 is gone, but it was replaced with $120. So you can always, trade back into the marketplace, usually. So buyer pays the premium, seller receives it, and look at that. I'm ahead of myself here. So you can always trade back into that market. You can always close out that option. You can buy to close, sell to close. And the premium, as we talked about earlier, because it represents 100 shares of stock, we take whatever that option premium is and we multiply it by 100. $3 option premium is $3 to $100 in the real world. Now, option premium is made up of a couple things. This is where things get a little tricky. There's a couple core concepts here, one of which is called intrinsic value. Intrinsic value is simply the difference between the stock price and the strike price. Again, do I want to buy stock at $50 if it's trading $55 in the market? Do I want to buy stock for $50 if it's trading $55 in the market? Absolutely, all day long. Okay? That difference of $5, that's what we call intrinsic value. Okay? That option inherently has $5 of value to it. Because I can buy stock for 50, I can turn around and sell it for 55. It intrinsically, inherently has $5 of value. Is that clear? Now, that's not to say that the option contract is only going to cost $5. It might cost me $6. That extra dollar of premium is what we call time value or extrinsic value. Okay? So time value is anything over and above the intrinsic value of the option. time value decays. There's, some of you that may have a, kind of a toe in the water when it comes to options. You may be familiar with the phrase time decay or theta. Is anyone familiar with time decay or theta? Yeah? Okay. What it's telling us is, and we're going to break it down in just a second, but time decay is telling us this. If part of the option's value is time, and that time is finite, if I enter into an option contract today, it's good from today until 3 weeks from now when it expires. 2 weeks from now, I've got less time. A week after that, there's even less time. So the value of that option, simply because of the time component, is going to decrease on a daily basis. That is called theta. It's a Greek term, and it represents the amount by which that option contract is going to decrease in value, all other things remaining the same. That is going to decrease in value on a day-to-day basis. And while we won't get too much into it because that's more of an intermediate concept, that is theta. That's time decay. At expiration, and the reason that it decreases, at expiration, your option is only worth its intrinsic value. We talked about in, at, and out of the money. Out of the money, your contract has no value. Do you want to buy stock at 55 if it's trading 50 in the market? No, of course not. That option contract has no value. All of that time value, all of that intrinsic value, that extrinsic value is gone. So let's break it down a little further. The option premium, the intrinsic value, and this is a graph that I came up with, or an image that I created a couple years ago that I really like, so I hope that you do too. Intrinsic value is simply the difference between your stock price and your strike price. The time value, this is where things kind of break off a little bit. First and foremost, it is time. How much time do we have left in the options contract until it expires? There's also a concept called volatility, and that's where things get really nuts. All right, if if you're a little bit into options already, and you're familiar with volatility or have an inkling of volatility, volatility is the most difficult to explain, the most difficult to account for component of options pricing. Again, that's more of an advanced concept. Certainly, we have a wealth of information on volatility on our website, optionseducation.org, or you can ask myself or contact Investor Services, and we'd love to talk to you about volatility. But volatility is the next concept of time value, and then the last is simply the cost of money, interest rates, dividends, right? Things like that. So that is how the option premium is broken down. Now, what does all that mean? Well, in the money calls and puts, right, that have intrinsic value, in the money calls and puts have intrinsic value. They also may have time value. If I buy an option and it costs $5, I got $5 intrinsic value, but actually I have to pay $6 in the market. That $1, as we talked about, is going to be the extrinsic value. That's going to be the time value. At the money options and out of the money options have only time value. And again, like we had mentioned previously, because of theta or time decay, that intrinsic value, that extrinsic value is always decreasing. And let's look at an example. XYZ trading $53 a share. I buy the January $50 call. I pay $5.20. All right. Stock's 53. I buy a $50 call. How much intrinsic value does that option have? $3. Absolutely. It's going to be the difference between the stock price and the strike price. How much time value does that option have? Did I hear $2.20? $2.20. Anything over and above the intrinsic value is the time value, $2.20. If I buy the $60 call, stock's trading 53, cost me $2.10 to buy this option. What is the intrinsic value? Stock's trading stock's trading 53. Do I want to buy it for 60? No. Intrinsic value, 0. Very good, 0. Time value, everything else, $2.10. Last quiz here before we get into Q&A. $77 stock, $70 call, cost us $10.50. In, at, or out of the money? In the money. We want to buy shares for 70 when they're trading 77. Absolutely. Intrinsic value. $7, right? We can buy stock for 70. It's trading 77. $7 of intrinsic value. Everything else is going to be the time value, 3.5. And I do want to take Q&A. I'm assuming you have questions, so I'll go ahead and we'll just go through this slide here. You do have the ability to download all of the slides that we've talked about, as well as the ones that Kevin is going to be talking about a little bit later. And then Kevin and I are going to give a joint presentation for the third session. So you do have access to download all that information. This is our last slide. So I just take a quick moment about OIC, and then we're going to get into Q&A. For those of you brand new to options, okay, how many of you have never traded an option before? Okay, wow, so there's quite a few that have. Excellent. For those of you that haven't, and even those of you that have, if you're looking to become more of an expert, or if you're looking just to further your education, definitely Options Industry Council is the place to be. As I had explained, all of our services completely free of charge. We have an online education program with online courses ranging from the very basics of what is an option to more complex concepts such as volatility, as we just briefly touched on, and we get into pricing a little bit more, and definitely make use of our investor services team. We do have live options help that give us a call, shoot us an email, send us a chat, and we'll certainly be happy to answer any questions that you have. So, speaking of questions, why don't we first, let's take a question from online. Frank, do you have anything for us? I'll repeat it. Okay, so for those of you that didn't hear, in, at, and out of the money, there's a concept called pin risk. Okay? What pin risk is let's say you've got a stock, and we just recently saw this with a couple expirations. Let's say you've got a stock, you've got a $50 call. And let's say you sold that $50 call. So you now have the obligation to sell stock at $50 if you get assigned. If the stock is trading, expiration Friday, we've got maybe 10 minutes until things expire, and the stock is trading $49.95. All right, we're a nickel away, 6 cents away from that option being in the money and having to sell our stock. We now have what we call pin risk. We don't know if we're going to get assigned on that option contract. We don't know what's going to happen over the next couple minutes, whether or not that stock is going to rally to close, and now we get assigned. Now the stock closes at $50 and a dime. Or if stock's going to go the other way. We don't know what's going to happen. There's another saying that we have on the floor: when in doubt, close them out. If you don't know that you're going to get assigned and you're worried about assignment, the only way to avoid assignment is not to have an assignable position. And I know that sounds very rudimentary and almost insulting, but the only way that you can be assured that you won't get assigned on your contract is not to have a short contract position. So pin risk is when you don't know if you're going to get assigned or not, and you need to make a decision. Do you want to keep that option contract open? Maybe you buy it back in the market for as cheaply as you can, or do you take the chance? All right. When in doubt, close them out. Something that we're very fond of saying on the trading floor. Audience, does anyone else have a question? Sir, Kevin.
Is it possible that when you place the order, no buyer on another side or seller?
Sir, I'm sorry. Can you repeat that?
If you're placing an order, in possible, if it's possible that anyone buy or not buying.
If you place an order, can you be positive if anyone is going to buy or sell the contract? Is that right?
Is it possible to place an option order where there's no buyers, or where you try to sell something, there's no buyers, or you try to buy something and there's no offers?
Absolutely. When you look at an options chain, and Kevin's going to get into that in the next presentation, an options chain is simply a table that shows the markets, where the crowd is willing to buy, where the crowd is willing to sell. If you see an option chain and the market is zero bid at a nickel, it means nobody's willing to buy that option contract. And typically what you're going to see, you're going to see that a lot on expiration. $50 call, stock's trading $49.50, all right? Who's going to want to buy that right to buy those shares for $50 when they're trading $49.50 in the market and we only have 10 minutes left until expiration? So that's going to be, you're not going to have a buyer for that. It's going to be zero bid on that. You may also not have a buyer or seller depending on how heavily traded that option is. All right, there's a term that that people float around in the market, and it means different things to different people, so we generally try to avoid it, and that's liquidity. And really, again, it means different things to different people, but if you have an option or you have a security that maybe people don't trade very often, the underlying doesn't trade, the stock doesn't trade, and no one's willing to buy it. The market is made up of market participants, buyers and sellers. The more buyers and sellers you have, typically the easier it is to get in and out of your options contract. But let's say there's a security and you and I are the only market participants, and you want to buy something and I'm the only one willing to sell it. I now control the price at which you need to buy that contract. And then conversely, if I'm looking to sell and you're the only one willing to buy, but you're not even willing to buy, you're the only one in it, and you're like, no, I don't want to buy this thing, then I don't have a choice. I can't sell my contract. You can only buy what somebody's willing to sell, and then you can only sell what somebody's willing to buy. When they talk about what is an option worth, an option's worth just what anything else is worth. It's worth what somebody's willing to pay for it, right? I see, it's funny, I see, I'm big into concerts, just as Kevin is. And I love when I see that a concert goes on sale and tickets are going, people are asking $5,000 for a front row seat, or the Super Bowl, for example, right? $10,000 for a ticket. Tickets aren't, worth $10,000. Nobody's paying $10,000. Somebody's offering it at $10,000, but that doesn't mean that's what it's worth. It's only worth what somebody's willing to pay for it. And if no one's willing to pay for that option, it's not worth anything. Any other questions?
When you're placing, when you're trading options, do you use the fundamental side of it, or do you have to learn how to trade technically?
Fundamental or technical analysis. It's funny that you mentioned that. We have next month, this is what, April? I'm sorry, in June, we have the OIC is putting on an options summit that we do every year. It's a 4-part webinar. And we are going to be bringing in outside parties to discuss that very question, fundamental analysis and technical analysis. What do you use? It all depends on what works for you. A lot of people think that the fundamentals are the way to go. Some people are more into technical analysis. They have that kind of brain. I prefer the dartboard. That kind of works a little bit better for me. Close the eyes and. But it depends on what works best for you, whether it's fundamental or technical. But I would definitely, if you're interested in that, and for the rest of you that are interested in fundamental and technical analysis, it's definitely a more intermediate concept. But if you're interested in that, I highly recommend that you go to the OIC website, and I believe we have registration open for the June summit. If registration is not open as of yet, it will be very shortly. It's going to be a 4-part series, all done online. And again, with all of our presentations that we do, certainly the online ones, they are all recorded and available for replay. So if you want to sign up for that and just replay it at your convenience, I definitely suggest that you take advantage of that. I think, do we have time for one more? One more short one.
In the interest of time and with the online audience, this will be the last one. As you know, we're going to be available to answer questions, and you'll have all sorts of resources online if we don't get to it right now.
Okay. The question I have is, you were talking about the when you get into the contract, have a plan to get out.
Yes.
So it is easy when it is going in my direction. When I put in a call, it is going up, it's very easy. The question I have from my side is, since you have 20 years of experience, what is the plan or what are some of the best practices you do to cut off the losses? Do you have a certain percentage in mind?
Okay. The question is, obviously it's very easy when things are going your way. You sit on the contract, you know, you're making money, maybe you close it out, take a position or take a profit. What happens if that's not the case? What happens if you're losing money? There's certainly different things that you can do. Position management. Again, this is kind of more of an intermediate concept. A lot of our resources on our OIC website and our YouTube channel talk about position management, but there's a couple things you can do, one of which is called rolling your strike. You could buy back, let's say you bought an option that's not working out. You could sell that to the market, use that money to buy back another option, maybe a lower strike or a higher strike, depending on which way you're looking to go, and try to recoup your losses that way. Maybe if you bought an option, you thought the stock was going to go to 50 and it only went to 45, but you're still bullish on it, you still think it's going to go up, maybe you just need more time. So you sell out your, say, your current contract, your April contract, and maybe you buy yourself another 30 days worth of time. That's called rolling out. Or you could combine the two, roll up and out, roll down and out. Right? There's definitely different ways that you can manage that position by changing your current contract into a new one. And ladies and gentlemen, I'm told that is it. As Kevin had mentioned, we are going to be here for some personal questions. During the interim, we do have sessions 2 and 3 coming up. So for now, I definitely thank you for your attention, and we will be around for more.